Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And we're going over our old friend MercadoLibre, and it's up 94% over 3 years. And folks, let's see what this stock is all about. But first, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Okay, MercadoLibre hosts online commerce and payments platforms in Latin America. We can call it the Amazon of Central and South America. And its services are designed to provide its users with mechanisms to buy, sell, pay for, and collect on e-commerce transactions. Has 84,200 employees. Now, folks, this is an doubling of the number of employees in the past year and a half. So this company is growing, definitely. Now, some news from 3 weeks ago. Shares of MercadoLibre jumped 9.3% yesterday. Now, this is 3 weeks ago. After recent geopolitical developments in the Venezuelan economy could finally open its borders to MercadoLibre's, and we call it MELI for short, full suite of logistics and fintech services. Now, the sudden prospect of accessing South America's fifth largest population under a more open economic framework drove the stock to double-digit gains. Now, market share has increased. Get these numbers, folks. Market share has increased over the last 3 years as its 39.4% annual revenue growth was exceptional. It sure is. An expected revenue growth of 33% for the next year suggests its market share will rise. Well, I should hope so. So let's look at MercadoLibre over the past 3 years, the 3-year average relative to the average stock. Now, the average stock, mostly in the S&P 500, are in blue. So we look at the clean surplus return on equity, and we liken this to a bank. Would you rather put your money in a bank that's giving you 13.5% or one that's giving you 63%? Yeah, that's how we relate this to something that we can all understand. Net income growth. Now, net income growth is earnings minus non-recurring items. What does that mean? It means that we only use the net income, which is income from the core operations of the companies. Now, in other words, if MercadoLibre sold some real estate and moved to bigger offices or something like that, the profit on the real estate would show up on the earnings for that year. Well, net income takes that out because selling property is not their core business model. So that's what net income means. And yeah, net income 48% versus the average stock at 13%. When we look at revenue, we're looking at a 3-year average of 32% versus the average stock of 7.1%. So you could see Mercado is leading in all areas over the average stock out there, which means it should, over time, outperform the average stock. Now, if we want to look at numbers, here's that net income again. I just want to show you that down here, yeah, there was a time when it actually lost money. And this was a time going into 2022 where it started making money in 2021 and then 2022, and things weren't so good in the stock market here in 2022, but this stock was actually making more and more money. Look how the net income has increased. Yeah, and we look at the clean surplus return on equity, and again, that's a comparable return on equity, and it's not the same return on equity you see on the income statements in the balance sheet, or that you get from the income statement and balance sheet. This is the return on equity that can be compared to other companies. And to get into our growth stock portfolio, we want to see a clean surplus ROE of 20% or greater. And yeah, this stock certainly fills that bill. Retention rate, it's taken all the money it makes and put it back into itself in order to grow. And the net income growth rate and the revenue growth rate, we can see down in here, this is why the stock has had a difficult time over the past 6 months or so until just recently, because the net income went down. Net income is profit, don't forget that, and went down maybe because it hired so many people. So we don't exactly know why, but back up again for 2026. Revenue growth, again, the average revenue growth for the average stock out there is 7.1%. Years to pay debt, This is Buffett's rule of thumb that says if a company takes all the money it's making, how many years will it take to pay off its debt? His rule of thumb is 5 years or less. Our rule is 3 years or less, and this company can pay off its debt in 2.1 years if it wants to pay off all its debt. So in other words, it doesn't have too much debt. And 3 years, black line is the S&P 500 down here, which is up 74%, which is excellent for this index over 3 years. That's a 24% return over 3 years. Now, the average return for the S&P, on average, over 50, 60 years or so, is 10%. So you can see 24% per year is just extraordinary here. And Mercado, or what we call MELI, really up, and then all of a sudden it just had a hard time. And this year, right in here, we can see it's starting to move up once again. And let's take a year to date, which is only 20 days as I'm recording this. And black line is the S&P 500, up about 1%, 1.1%, and Mercado up almost 6%. So Mercado's doing very, very well this year to date. It's in our growth portfolio, and we really like this stock, folks. So remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. So folks, it's the weekend. Take your mind off the market. Get out there, play on the beach, play in the snow, wherever you are. Be with your family. And folks, we'll see you right back here in a couple of days.